I think all the relationships we've been looking at, we've been leaning on for macro, for markets, you need to rethink. We've lent on those things the last 20, 30 years. They're all going to, I think, break down. One of the main reasons, predominant reasons, is this theme of deglobalization. I think globalization has peaked and in some aspects reversing. I think the incentives have changed. I don't think this is a theme that reverses. I think this is a trend that's multi-year, multi-decade. I think structurally it means the high inflation we're seeing now isn't temporary, it's structural. I think it persists, not at these levels, but it persists. To give you an idea, I think inflation in the last 10 years across developed markets averaged around 1 to 1.5%, depending on which country you look at. The next 10 years, I think it's going to be averaging 2.5 to 3. Doesn't sound a lot, but cumulatively, that mounts up. But a much more important issue isn't the level of inflation, the structurally higher inflation. I think the much more important issue is going to be inflation going forward is going to be much more volatile. So we're being used to actually a period of inflation which has been incredibly stable, ranging between 0 and 3%. I think the world we're going into is inflation swings up, swings down, and probably ranges between -1 and +6. And I think that is really, that volatility is really, really important. The other aspect that then leads to is that cycles are back. Cycles will become much more frequent and much more violent. Supply side becomes more sticky, demand will be fluctuating, and we're back into a world where you get a trade-off between growth and inflation again, which means central banks aren't your savior, which means central banks have to be very confident growth is turning down and sufficiently to get inflation down before they act. So the world we've been living in for the last 15 years as central banks compress vol, I think that's ended. Central banks are now a source of volatility going forward and will exaggerate cycles in the market and within economies. So that changes the relationship between equity and bonds. You know, we've been used to this environment where equities and bonds have had this negative correlation. A world where the last 15 years, strong growth is good for equities, bad growth is good for equities because it just means more liquidity. I think that's ended. You know, the liquidity won't be there as a savior every time there's a downturn. Equities go back to pricing cycles and pricing profits. Bond markets, strong growth going forward, I think will be negative for bonds. Negative growth, I think, would be negative for bonds because it would just be even more fiscal issuance on the way. So I think the relationship between equities and bonds are shifting. So the final 3 points I would kind of make related to that is I think one thing that's most missed out in price, I think, structurally, is risk premium. The world I'm talking about is higher inflation vol, higher cycle vol, higher vol around your institutional credibility, and much less cross-border transfer of savings. That should mean risk premium rises, not a little bit, but substantially over the course of the next few years. Second element of that, I think, is where are we now? We're at one of those moments where the cycle's turning over, but the central bank can't react, must carry on tightening because inflation is high. And in that environment, the market must price a higher and higher probability you're heading into recession. At some point, the central banks will blink, and when they blink, that will be the opportunity to look for the cycle to turn and time abruptly. But you're going to have violent swings and much more frequent cycles. And I think we're in one of those exactly at this point. And then the final point is I think this deglobalization world means fiscal becomes the dominant policy tool, not monetary. So localized stories become really important. Idiosyncratic stories become important. The opportunity set is going to be much more about relative country stories. That will matter much more than it has done over the last 10 years.